Hello everybody, my name is Sean O'Leary and I'm a senior in the AIM program covering international industrials. Today I'll be pitching ASHTY Group, ticker ASHTY, and a little bit about my screening process. I was screening to find a company that was being bought by international mutual funds, has shown strong revenue growth in the past 5 years, and has proven to adapt well to the COVID-19 environment that we're in currently, and I landed on ASHTY Group.
Moving on to my introduction. ASHTY Group participates in the provision of construction, industrial, and general equipment rental services in the United States, the United Kingdom, and Canada. It operates under the following brands: Sunbelt US, which makes up 86% of fiscal year 2020 revenue, Sunbelt UK, which makes up 9%, and Sunbelt Canada, which makes up 5%. The range of rental products is offered, including aerial work and platforms, forklifts, earth-moving vehicles, pump and power equipment, scaffold, panels, fencing and barriers, and many more. ASHTY provides these rental services for markets that include facilities and maintenance and municipalities, emergency response, construction, and entertainment and special events. ASHTY was founded in 1984 and is headquartered in London, England. Moving on to my recommendation. Ashtead is a leading provider of rental equipment in the US, Canada, and the UK. They are second in market share in the US and Canada, and the largest in the UK, making up 10% of market share in the US, 5% in Canada, and 8% in the UK. In the last 5 years, Ashtead has grown sales at a 14.5% CAGR, keeping steady net margins and generating an average ROIC of 13.5% over the same period. This growth has been driven through a cluster strategy that Ashtead uses to create a competitive advantage. The cluster strategy provides a comprehensive product offering of scale and convenient services to customers wherever the job site may be located. Ashtead has seen significant losses related to the closures because of COVID-19, but has been able to adapt and bounce back to allocate this equipment in different types of markets that are in higher demand. An example of this is when Ashtead assisted through providing equipment to help the UK build testing sites throughout its country. This is an area that they normally do not operate in, but have been able to adjust to provide its services elsewhere. Ashtead has over 1,105 rental stores globally, and since 2006, the number of stores has grown at an 8% CAGR. With this growth, profit margins benefit as stores mature and are able to deliver more revenue and diversify their fleet and customer mix. Ashtead has also decreased their exposure to the cyclical non-residential industry from 55% of 2007 revenues to 46% in 2019. In this process, they also increased their exposure in specialty rentals from 16% in 2011 to 24% in 2020, which is an area that is easier to penetrate and less cyclical than the construction industry. With a typical 8-year holding cycle for rental assets, Ashtead is due for a capex replacement cycle within the next 3 to 5 years to reshape their asset mix to match the emerging demand in the post-pandemic environment. Ashtead can remain confident in their financial ability to fund this capex in the near future through the record free cash flow achieved in fiscal year 2021, quarter one, along with the increase in the senior secured debt facility by $500 million until the end of fiscal year 2021. This provides more financial leverage to navigate through the pandemic and fund growth in the future through strong cash generation and adequate capital. Due to strong market share growth and the use of the cluster strategy, margin growth as new stores mature, exposure to more market penetration to the specialty rental sector, and strong financial leverage, it is recommended that Ashtead be added to the AIM International Equity Fund with a price target of $170.77, representing a potential upside of 17.37%. Moving on to my drivers. My first driver is the cluster strategy. Ashtead's cluster strategy has allowed them to create a competitive advantage in the way they serve their end markets. The cluster strategy goal is to provide a collection of large and small rental locations in developing markets. This provides more convenience to customers, and the accessibility to more stores and the blend of small and large locations allows for specialty stores to broaden and diversify the customers served. Many competitors do not have the scale that Ashtead has, and the cluster strategy allows for a greater scale to broader range of markets unrelated to construction. It leads to better margins and ROI. Currently, Ashtead is second in market share and controls 10% of the rental equipment services industry in the US. Large players are benefiting from the cost benefits and scale in the rental market. The market share enjoyed by large players is likely to grow by a further 30 to 40% in the medium term. Ashtead has set a 50% target market share in the US and is well positioned to benefit from the growth in large players in the rental equipment industry through its cluster strategy. Moving on to my second driver, store maturity growth. Sunbelt Stores in the U.S. has grown with 11% CAGR from 2006 to 2019, and ASHTY has set a target of 875 stores in the U.S. by 2021. This would be a significant growth from the 658 stores it had in 2018. This expansion strategy has left a variety of branches that are at different stages of maturity, and close to half of the branches are less than 5 years old. This is important to note because mature branches compared to new ones yield a 10% higher EBITDA. So as branches mature, margins improve. Moving on to my third driver, strong financial leverage. A record free cash flow of $578.8 million was recorded in quarter one of fiscal year 2021, driven by reduced capex and a well-invested young fleet. ASHTY has been able to grow its business while maintaining cash generation because of stronger margins and scale. A net debt to EBITDA leverage ratio of 1.8 times was reported in quarter one of fiscal year 2021, which remains within the target of between 1.5 and 2 that management has set. This provides flexibility and leaves ASHTY in a strong position of its current cycle as the pandemic continues on. Moving on to my valuation. In order to reach an intrinsic value for Ashtead, a 5-year DCF model was constructed. Using a terminal growth rate of 2% and a WACC of 7.98%, an intrinsic value of $181.73 was reached. A sensitivity analysis of plus or minus 25 basis points on the terminal growth rate and plus or minus 50 basis points on the WACC ranged from 135.85 to 258.43. Furthermore, an EV to EBITDA multiple valuation was utilized for a weighted peer average multiple of 7.7. The result was an intrinsic value of 146.58. A PE multiple valuation was also calculated using a weighted multiple of 21.55, resulting in an intrinsic value of 162.06. By weighting the three valuations 60-20-20, a price target of 170.77 was reached, which yields a 17.37% upside. Ashtead has a dividend yield of 2.35% as well. Moving on to my risks. My first risk is non-residential construction decline. Non-residential construction remains a near-term risk as remote working and digitization of workflows raise concerns around the demand for commercial real estate going forward. Data on non-residential construction illustrates some indications of weakness, particularly in non-building construction. As industry growth remains down, customers in this industry of ours will not need the equipment that we provide for them. My second risk is cyclicality. Ashtead is a cyclical business that with any sustained decline in construction activity will impact revenue and profitability. The construction industry typically lags the general economy by 12 to 24 months, and this could have an impact on Ashtead in the future. My third risk, currency and interest rate risk. Financing and trading activities expose Ashtead to various financial risks that could adversely affect current and future earnings. Ashtead has 92% of its debt, and the majority of its assets, liabilities, revenues, and costs denominated in the U.S. dollars. The management reported that according to the current currency mix of their profits and on the U.S. dollar debt levels, interest and exchange rates at the end of April 2020, a 1% shift in the U.S. dollar would adversely impact pre-tax profit by up to $14.22 million. Moving on to my management. Brendan Horgan has been Chief Executive since May of 2019. Prior to this position, Mr. Horgan worked as Chief Operating Officer of Ashtead for over a year and as Chief Executive of Sunbelt and a Director since January of 2011. Michael Pratt has been Finance Director since April of 2018 and has worked in multiple accounting and finance roles within Ashtead, giving him a detailed understanding of the business. I appreciate you listening to my presentation, and I look forward to your questions.